Hello, welcome to this video. Today we're going to be talking about technical analysis. Last video we talked about fundamentals. This is the flip side, as we've already spoke about. Both fundamental and technical analysis both drive the markets in a nice 50-50% ratio. Now, we both know that neither one of them is perfect. If you're a technical trader, not everything goes to plan, and if you're a fundamental, nothing always goes to plan. The key is just to have that nice little balance. Like we spoke about the fundamentals, I watch the news, I listen to it, but I won't trade from it. I'm a technical trader, and this is what I do. And I've just put a few charts up on my screen here just so we can talk about a few of them. But just a little brief description. What is it? What is technical trading? It's all about using historical data, pricing patterns to predict future moves based on history repeating itself. It's also called charting, as we use the charts to base our trading decisions from, and the patterns that it's made in history. There are many traders using the same techniques as that we do when we're trading, so whether the patterns actually represents change is based on how many traders see, believe and trade the patterns. The volume of trades in the market will determine whether this will be a self-fulfilling prophecy or not. So if many traders see that there's a trendline break, such as this on the euro, or trendline bounce, if many traders see this little pattern here, then they'll be going short, and therefore this trend line became a self-fulfilling prophecy. Whereas before it was just a line on a chart that never really represented anything. But it's all about the people's perception of what they think is going to happen after this, and if it's a strong signal, then it becomes a self-fulfilling prophecy. More traders enter the market on a short emphasis, and the market begins to drop. So that's where the self-fulfilling prophecy comes from. But whether these lines actually mean anything beforehand is irrelevant. We use the historical data to define patterns of probability in our trading. Many patterns are very successful and work about 80% of the time. Some are more unstable and not so probable. So you will get some that work better than others, and just so you know, they don't always work 100% of the time. Nothing does. So that's why we always put stop losses in place, because sometimes the market will always have a bigger picture in what it wants to do. Let's say, for instance, these little short-term trend lines might mean nothing in the big picture. If the market wants to go long, it's going to go long. Just because it's made a little short-term break doesn't mean it's going to keep going down. Good thing about technical trading, by using the historical charts, we can backtest our trading strategies, basing our trading decisions on the rules that we set ourselves to define whether the strategy fits the market and your trading requirements. So we can always go back weeks, months, years, looking for the same patterns of probability that we're going to be using to trade today, and you can find out how many times the trades worked for yourself, how many times it's lost, how many pips usually get gained after this certain move, like a trendline break. After a certain amount of extension, you can expect a retracement of a certain amount of pips through a certain amount of time. But we use this history. It's worked for hundreds of years, and it's still working today. So we go back, base our rules on history, and that's how we trade on technicals. Unlike fundamental analysis, where the price is non-relevant because decisions are based on the future economy, in technical trading, current price is everything, even down to the individual pip. The overall price reflects trading decisions very different to a fundamental trading. So if we're, let's just say for instance, scalping using support and resistance levels, the individual price that's here, where it comes down to on this chart matters to the smallest amount, which is a pip. It's very precise. It's unlike the fundamentals where, like we said, they're based on news events. If we've got a new trend set by less jobs in a certain country, then the price is non-relevant in that respect, because they're expecting the price to go down over the next 4, 5, 6 months. So whatever the price is at during a fundamental trade, it doesn't really matter because it's got a long-term emphasis on it. But technicals is very precise, it's very exact, it's to the pip. Okay, so we can use technical analysis to predict market cycles like trending or range markets, which we can adapt our trading strategies to fit the market. Okay, so we can always see these little market cycles that it goes through, whether we're in a long-term trend or short-term trend. We can actually define those little changes, or after big moves then we go into range bounds market, like here. You know, you can see the market extended, then it went into a range of consolidation. We can draw some lines in here and figure out when it's going to have a little breakout, whether it's to the upside or to the downside. It's a good thing about technicals. Little chat about some of your indicators and patterns that we might use. On this chart, blue lines represent bollinger bands. On this daily chart, there's a 200 period bollinger bands, and what these guys do is, when there's a lack of volatility, they'll tend to close up. Like you can see here, there's a very small window. The bollinger bands squeeze, so that's a little range market in there. As soon as the volatility starts to increase and it starts trending, the bands will expand and the price will usually taper along one of the bands here until when the volatility starts to drop off. You'll notice you won't see the bands down here just now, but when the volatility drops off, the bands will start to close together again. As you can see, the market went sideways, 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 keeps going sideways until the bollinger band squeezes on again, and then as time goes on, look at this, we're very, very tight just now. Now what usually happens in a bollinger band squeeze, like we've seen back here, bollinger band squeeze for a good amount of time, and then boom, expansion. We're into our trade now. So it's a good little indication on what might happen, and that's just using one simple little indicator like a bollinger band. So we can be based in, we can use trend lines here. Latest trend lines might be like this. Draw one in the bottom to represent that. Now we can see it's starting to close in, everything's getting tight. So to make a trade on here, what you would do as a technical trader, when this price breaks above one of these lines, this is what you're going to base your trade on. You're either going to buy or you're going to sell, either or. And given that you've got this little bollinger band squeezed right here, you can expect a large breakout in volatility in the direction that it chooses to go. Which way do we know it's going to go? We don't know. All we can do is put probability in the favour based on historical data of what's happened before. As we can see here, we can do the same move. We'll draw this trend line in to there, and pretty much one for the bottom as well. I'll get rid of this moving average just now. So as we can see here, price was closing down, price was closing down. We're in the bollinger band squeeze, the market broke out of this trend line here that we drew. Now you might have had a false break when the price was here at the time. You would have got a false break. You might have got stopped out here if your stop was tight. Then you would have readjusted your trend line, and then you would have entered the market here, no doubt. Stop loss below there, that would have been a winner, and it would have been a very, very nice trade. Okay, so this is what we do using historical data to look for probability in current priced markets. Okay, so that was the Bollinger Bands. You see me, I deleted the moving average, but I'll get one of these back up for you. A good one to use is a 200 period on the daily charts. This represents a long-term current trend, so if you're below this, you'll be selling, not buying below this, and when you're above it, not selling when you're above it. That's a basic trend setter. Down here I've got a MACD. What a lot of people will do is when the chart opens up on the 0 line, it represents a buy. You might buy in there and then close out your trade when the red signal line closes above here. This shows a loss in volatility and a change of direction, so buy there, sell there. I don't use the MACD myself. I know a lot of other people do. It's a very popular indicator, but it's not in my style of trading. Other ones we use, trend lines. This is a long-term trend line of the Euro US dollar on the weekly chart. This price goes way back to 2008, just before the recession hit. It created a level here where we could actually draw a trend line in and then give us a level off. Now it took a long time to come down and then come back up, but as you can see, there was some price reaction along this level. There was a little bit of uncertainty. There was a lot of people that wanted it to break through, so there'd be buyers trying to push this market through, push it through, and then sellers entering the market thinking it's going to come back down. That's why you see the candles coming down. So there's a little bit of a battle here, and overall price has gone down. And how we know that is because I drew this trend line in here. I'll redraw it for you. So we're coming from the bottom to this. This is using the wave principle. This is the A, this is the B, this is the C, that's a D formation. A, B, C, D. That's one simple long-term wave. And after this D, price came down and has broken this little trend line here. So that's showing a short emphasis on the Euro US dollar weekly chart right now. So based on this, I'll be going short, but right now I'll be expecting a little retrace back up the way before I start entering the market. Okay, so other things with besides the moving averages, you can have golden crosses. Now what a lot of people might do to utilize the golden cross is utilize a 15 EMA versus a 50 EMA, and when you get a cross, you're buying. Let's just throw a couple of these up. So 15 and 50. We'll change this color just so it's a little bit easier to see, and I'll get rid of this 200 here. Okay, so the golden cross rules usually state that when you get a cross of this 15 exponential moving average below the 50, now you're short in the market, you're selling. Okay, so you can find all your little opportunities in here to sell, and then when it becomes a buyer's market again, it's when the 15 EMA crosses above the 50 again. Now it's a long market. Very simple, but problem with this golden cross rules is the price here is lagging because these are 15s. So you can see when this price actually crossed over the 50, the price was actually here at this time. So that is 12 days and 350 pips after its relevant move. So that's how much that lags. That's a good 2 weeks of trading after somebody could have got a signal here. Let's say if you were trading using trend lines like that, you would have got a signal nice and early there, whereas the lagging indicator gave you a move 350 pips and 2 weeks later. So I don't use moving average crosses in my trading either, but this is a description of what a lot of people do. Is when you first start trading, as you can see with the visuals of the moving average, it looks like nice trades can be made. The problem with that is you get into range bound markets like here, you're getting chopped about. You're going to be buying here, getting stopped out, buying again, selling there, market's going against you, just up down, up down, up down, up down, whiplash, getting taken out, and it's only once every in a while you actually come out with a profitable trade. But as we said earlier, like this one, when the price actually crosses through, you're looking at a stop loss of 300 pips on this daily chart. And what about the profit? Fair enough, but when that crossed back through here, price, there it is, there's your closing candle, you've actually 280 pips, so you're risking 360 for a 280 profit. So you can't just base it on simple moving average crosses. I've been there, I've done it, I've done lots of back testing on it. Like it says, the visuals look good and look easy on it. It seems an easy way of trading, sell here, buy here, sell here, but it's a little bit too simple. There's a golden rule of keeping things simple, but not too simple, okay? So we touched a little bit about the Elliott wave principle, ABCD formations. That's a technical analysis. You might be looking for chart patterns like higher highs, higher lows, lower highs. Other patterns, double tops, cup and handle formations, rising or falling wedges, flags, pennants, head and shoulder formations. That's just some chart patterns that you might be looking for. You might be using indicators like RSIs, which is a relative strength index, which shows overbought and oversold conditions, much like this one here. It's got a 70 and a 30 level put in there. When it's above the 70 level, it's usually becoming an overbought market, so people be looking to sell when you're in these conditions. These might be set at 80 and 20 levels, much like your stochastics, which represent the same conditions, overbought, oversold markets. So you buy down here, you sell up here, vice versa. You need certain rules for these things. You can't just base your trading decisions just on an overbought or oversold market. You need about 3 or 4 conditions to come into place before placing trades. Might be using support and resistance levels. Like here, support was drawn in, got a little double top here at the time, so you would draw a resistance level in here. As you can see, the price broke through that eventually, but then what was resistance now becomes support. Give a support level for this, which gave a nice little bounce. Did come back down and touched on the support level again, and as you can see, continued up, but you need to be looking out for these little key levels right here. Draw the lines in and then wait for the bounces. Now these support resistance level usually come in the tops and the bottoms of the ABCD patterns that we draw. So draw them in right here, draw them in there, draw them in there at that top, draw them in there, Now, nothing might happen at this relevant time, but if you keep these lines in here, you'll find out in a day, in a week, they can go on for years. But there'll be some price reaction at these levels one day. You can go back, you can go into the weekly charts, you can go into the monthly charts, and always notice, especially in weeklies, notice these key levels right here. You'll see there's a lot of action, because there's a lot of people watching these prices. Look at this, right there, right there, right there. If you had this support level in here at this time, which also reacted there, as you can look back, you would have made a nice, if you go into the 4 hour chart, 1 hour chart, whatever, you would have noticed a little candlestick formation in there where you've made yourself a nice tidy little profit. It's the same here, it's just thrown up a treble bottom there. Okay, starts off here, actually starts off here, almost there, but I was basing on here, 1, 2, 3, treble bottom, great chance for a trade. You could probably wait for the price to actually come down to this level on its third bounce, place a very very tight stop loss in just below that level, like that 86 would have been 85 pip stop you could have put in, and there we go, 1000 pip trade. Okay, easy as that. Selling at the bottom, sorry, buying at the bottom, selling at the top, and then you could have done easily the same. If you were on this weekly chart, there's a nice little doji candle, could have sold that, made yourself about 400 pips, comes up, throws up a little hammer, then a spike, and then drops down dramatically. Comes up another little double bottom there. So when you were here at this period of time, you draw this support level in, then you get this candle formation forming off this support line, and then look what happens, the price goes up. Okay, price has been going up, now we watched it throwing up a trend line break, that's the time to get out, and now it's a short market. Okay, get rid of these ones on the top. This price is going to come back down, and it's going to find a level of support to fall onto. Might be here, might be here, might be here, might continue all the way down. Nobody actually knows it. Another thing you could do for that same one is throw up a Fibonacci. Draw it from the start of the move to the end of the move. You're going to get a Fibonacci levels drawn in here. 23.6% retracement, 38.2 retracement, 50% retracement, 61.8 retracement, and I would put a 78.6 retracement in there as well. Okay, and then these will be levels to buy from. If you get a candlestick formation off of these, that's a great level to buy from. Okay, so that's what a technical trader does. He utilises all these tools at hand to base his trading decisions on. What happens in history usually repeats itself. Okay, whatever it is you use to trade, you will be using price and volume to recognize price patterns, and by backtesting on historical patterns, you will base your trading on similar conditions. There are 3 types of markets for us to spot: an up market, down market, and a sideways market. We can trade technically in all 3 market types, whereas a fundamental trader is either long or short emphasis at hand. We have a good edge here and can place a trade and get out in profit, knowing that the trade was executed in a systematic procedure. Okay, but you do need a sound trading system to be able to trade with technical analysis. You need rules in place, and to have your own system, it takes time to develop, and a lot of back testing, a lot of time and effort involved. And I'm going to have a couple of systems up on the website if you want to have a little look at them, and there's going to be videos on our advanced trading techniques, going into further detail on how to draw your Fibonacci's, how to draw your support and resistance lines, trend lines, the proper way to do them. But if you subscribe to the advanced trading techniques, I'll go into a lot more detail about that, but this is a description of what a technical trader does. This is my lifestyle. This is what my charts usually look like. But the little key thing about technical trading is what a lot of people do is they like to throw on all sorts of many signals and having all these things up and hundreds of moving averages, and there's a lot of things going on here. Get some bands up, 100, 200. Now as you can see, the chart's looking very cluttered here. It's not a good way to trade if you have too many things on the go. You might think with the more indicators and whatnot that you have on your charts, the better systems that you might get in place, but what a lot of these do is they tend to contradict themselves, and you're going to get confused, and you're never actually going to base a trade with all this confusion on the charts, because this might give you a signal, this might give you a signal, but this doesn't, but this does. How are you meant to base it on that? You don't know. It's going to be too confusing. So you need a system which has been time tested. It's nice and simple to use. I use it every day. It's nice and simple, so when I have it on my phone, it's easy to look at, it's easy to operate. Okay, so I've got my system which I developed. I put time tested research into it. Obviously I'm not going to show it here, but that will be in my little online shop. I'll be selling an ebook and video tutorials about how to trade my system. You can get the templates for it for your MT4 platforms, and don't forget to check out the advanced trading techniques, and we'll go into depth in our Fibonacci's, our support and resistance levels, our trend lines, and which indicators I use. Okay, so thanks for watching this video. I hope you enjoyed this one, and I'll see you in the next video. Thank you.